We started with fundamentals of insurance, which was conducted by Mr. Batanda Ronald on Tuesday this week, 10 to midday. Yesterday, we had the live class, which was conducted by Mr. Joshua Akena. And today we shall be conducting a general insurance session, or what we call non-life insurance. And already our facilitator, Mr. Simon Bashabe, is ready, he's here, ready to take us through. Now, fundamentals of insurance, general insurance and life and pensions business are part of our certificate in insurance. What happens is that once a student completes fundamentals as a compulsory paper and also undertakes either general insurance or life and pensions business, they get a certificate of proficiency in insurance. Now, from the certificate of proficiency, we move to the certificate in insurance. And that is why tomorrow, Friday, we shall be conducting 2 sessions. We have bank assurance in the morning, which will be followed by professional selling skills. What that means is that once the student has completed a minimum of 5 papers, they can now receive or be awarded a certificate in insurance. So look out for our sessions tomorrow in bank assurance and also in professional selling skills. Now, I need to inform our participants that knowledge does not end, ladies and gentlemen. It does not mean that because you have undertaken a COP, you should limit yourself to either non-life and fundamentals. Please join us again tomorrow for bank assurance and professional selling skills so that you can then get to understand some of these emerging trends. Each one of us requires professional selling skills. These will be undertaken tomorrow. Now, as is the practice, my name is Jonan, who is the Deputy Principal of the Insurance Training College. I would like to welcome many of you, but also my colleagues. As usual, Ronnie Balimunsi is on standby to assist our participants. In case of any challenges, please get in touch with Ronnie Balimunsi. His telephone number is available on our flyer. He will be able to get, if any of our colleagues or your colleagues is having challenges joining in, please contact Ronnie. Now, I would want to assure you and also inform you that we are very happy with this move online. We know we have been affected by the pandemic, by COVID-19, but again, we've picked a number of opportunities. Now, as the Insurance Training College, this is one of the opportunities that we have picked, and we are saying this is now the new normal. We shall endeavor to now reach you in as many sessions as possible, because with the online training, it simply means you don't have to move away from where you are. With the comfort of your home, you can be able to receive this training. I am working from home right here in Wakiso. I have been working from home for the last about 4 weeks. We are into the 5th week of the lockdown here in Uganda, and we are continuing to work. So the lockdown and the pandemic also brings opportunities. And I want to challenge you that from where you are, please again take advantage of technology and also be able to use and take advantage of these opportunities. Now, for the webinar we had on Tuesday, we had about 110 participants, a record number for our first webinar we had as the college. Apologies for that. The webinar we had on Tuesday, which was fundamentals, we had over 80 participants, about 88 towards 90. But yesterday, Tuesday, for life and pension business, we had about 110 participants. These are very high numbers and a record for us who are going online for the first time. Now, I would want to guide in terms of how we are going to proceed. I know you have a number of questions that you want our facilitator to respond to. I would want to request that you send the questions via the chat, the Zoom group chat. Now, because it's a session, a training, and not a meeting, we are going to use the group Zoom chat. Once you type your question, please leave your name as well, because many of you are using devices that are not attached to your names. Kindly leave your name. It would be good for us to know who is asking the question, but send that question on the group chat, on the Zoom group chat. I'll be then reading out those questions at the end of the session. Our expectation is that the flow will be as follows. The facilitator will take you through for the first about 45 minutes to 1 hour or 1 hour and a half, depending on how fast he will have moved. And then after that, we'll have a sessions for Q&A, where we will then be reading out the group chats, and those will be sent to the Zoom group chat. I'll read them out, and then the facilitator will be responding to those questions. But then again, like I mentioned, we are organizing a Q&A session. That Q&A session will take place on Monday. Now, because of the numbers, I have already told you on Tuesday for the first webinar, we had almost 90 participants. Yesterday for live, we had over 100 participants. Today, we again expect a number of participants. It's not possible that we shall be able to respond to all your inquiries. So please send your questions beforehand to trainingdepartment@iiu.sc.ug. Now, we shall be handling these questions. The tutors will be in the Monday session, and we shall communicate and let you know the time. They will be here to take on those questions. So it is better that you send your questions through, those that you thought about during the session, and also those that you came along or you came across during this period after the session. We shall be taking on those questions and responding to them in general on Monday. But today, we shall take a few questions which we shall be responding to. It is exactly 10:09, and I know yesterday we started right on time. Today we have started right on time. Every single day we are improving, which is a plus for us. So I would want now to introduce our trainer. Like I mentioned, Mr. Simon Bashabe is already on hand. He's here, he's ready to take us through this session. Mr. Simon Bashabe is a seasoned insurer. Now, for many of you participants, I'm sure you've interacted with him either in class or in the industry. Mr. Bashabe has been practicing for almost 15 years. Mr. Bashabe is an associate of the Institute. Mr. Bashabe holds a diploma and is also a chartered bank assurance specialist. Mr. Bashabe's experience in insurance spans around sales. Mr. Bashabe has been one of the leading sales professionals in the industry, and he has won a number of awards. So I am happy to introduce Mr. Bashabe and to now request him to come in and take on the training. I wish you fruitful deliberations today, and I hope these trainings are adding value to you. I'll return at the end of the session to then take you through the Q&A session, but also to wrap up this. Thank you so much, and all the best. Over to you, Mr. Bashabe.
Thank you, Jonan. Good morning, students. Hope you are all well wherever you are, and you're going on well with the lockdowns. So today we are handling general insurance, and we're going to cover chapter 1 and chapter 2. And as already guided, this is a refresher course, a refresher training, meaning you've covered these things, but we are now taking you through to give you more maybe knowledge where you did not understand, to get acquainted with some concepts you did not understand. So we are going to somehow move so fast, given that you had covered some of these things. That is if you are not cutting classes. So our first chapter, definitely we look at, we introduce general insurance. You will know that we have two types of insurance: general insurance, which we call non-life, and life insurance. So for general insurance, we don't have a specific definition we can use that this is general insurance, but from our that this is non-life insurance. Sometimes it is also called short-term insurance, because you know for life insurance it's long-term. This is short-term. Why? Because are mainly give 1 year old. It's like the rest than a year, meaning you can take a policy for 3 months, 6 months, but you don't go beyond 12 months. Then these under general insurance, insurance company that offer these classes of insurance are referred to as general insurance companies or short-term insurers. So the examples of general insurance in Uganda, we have the likes of UAP General Insurance, Sanlam General Insurance, Jubilee General Insurance, Gold Star General Insurance, name it. And of course, when we discuss general insurance, we have to look at the characteristics of general insurance. What differentiates it from life insurance? As we've seen, we have life insurance and general. So what differentiates general insurance from life insurance? One, we look at that general insurance are contracts of indemnity. Many of you, or all of you, have studied principles of insurance and fundamentals of insurance. So when I say indemnity contracts, you understand. Meaning that general insurance is just there to take you back in case you suffered a loss. They take you back to the position you enjoyed at that time of suffering the loss. These are not benefit contracts. For general insurance, our aim is to take you back. If you had a car, a motor vehicle valued 10 million, and at the time of getting accident, that car, the value was 8 million. When we're compensating you, we only give you 8 million. Of course, I'm not putting other deductions, but you're supposed to be taken to 8 million, not getting 8 plus say 100,000. No, you must go back to 8 million, as opposed to life insurance, because for life insurance, those are benefit contracts. If you saved some money, of course, at the end of the day, you expect to get some interest and bonuses. But for general insurance, we take you back to the position you enjoyed. Friends, these are they are arranged on annual basis, but may be arranged also on short term. I've had already explained this, that these are contracts for 1 year, but if you want, if you show it, you can arrange it, say, for 6 months. Then 3, premiums are payable free at the time of taking policy and at renewal. So meaning that if I go to the insurance company and I want to buy a cover, say fire insurance, after completing proposal forms and my risk is accepted, before they place a cover, I'm supposed to pay all premiums fully. And when the policy expires, then I'm renewing. Of course, I'm also expected to pay the renewal premiums. Now, you see, this is different from life insurance, because in most cases, life insurance premiums are paid monthly, on a quarterly basis, annual basis, depending on the arrangement you agree with your insurer. But for general insurance, full premiums at the start of the policy. Now, even with this new policy of cash and carry, we no longer even accept the credit installments. We expect that at the start of the policy, all premiums are paid fully. Then the other characteristics is that the general insurance, the risk of loss or occurrence is not certain. There is uncertainty. So when you insure your house, you're not sure that the house will burn. If you insure your car, it's not a must that that car must be involved in an accident or it will be stolen. So the risk of loss here is not certain. This is why our brothers, the Muslim brothers, differ from this type of insurance. And they opt for takaful insurance, because for them, they say, our insurance, there is uncertainty. So they ask themselves the question that, if I insure with you my car and it doesn't get an accident or it is not stolen, so where do those premiums go? Because there is what? Uncertainty. It is not a must that the risk of loss will happen. Then the other characteristic, we look at insurable interest, where we say in general insurance, insurable interest must exist at the time of taking policy, during the occurrence of the policy, and at the time of loss. So it is throughout, at the time of taking policy, when the policy is running, and at the time of loss. So at every stage, insurable interest must be there. So meaning that if, again, my example I'm using of the car, if I insured my motor vehicle and it gets an accident, it means at the time of claiming, I must prove that I own this car, that I have insurable interest in this car. I believe you know insurable interest. That's why I said we may not go back to such principles. We believe you covered them under fundamentals. Then last on characteristics, partial claim payments are made. And you see, under life, you cannot be paid partially. But you see, for general insurance, if my windscreen of my motor vehicle breaks, I will go and they fix the windscreen. If the windscreen breaks, it doesn't mean that they have to hear. So those are some of the life insurance. For general insurance, this is very simple, you know this, but quickly we look at insurance is a tool which reduces the cost of loss. Very clear that if you insure, in case a loss happens, you don't suffer total losses because you'll be compensated, and instead of having total losses, insurance will put you back. Yes, there are some few contributions you'll make, like those of excess, excess, but at least most cases say 90% of what got lost will be put back. Then insurance provides protection. Definitely, when you insured, you protected. In case of anything, insurance will deal with it. So you don't have to worry. Then insurance provides peace of mind. Very important. If you insure, you can sleep comfortably because whatever will happen, insurance will be there to deal with it. Peace of mind, very important importance of insurance. In fact, for those of you who are selling insurance, I don't have to worry that my car will be stolen, my house will burn. Now, many of you who are on social media, you know what is happening with our Lake Victoria. So those people surrounding Lake Victoria, those are the areas we had wished to stay. But now if they told you to go and buy a plot next to Lake Victoria, I don't think you can go there. So most of those houses, beaches have flooded. And so for those who had insurance, yes, for them, they don't worry. Yes, their properties have been, destroyed by water, flooding waters. But as we talk, they have already, I think, forwarded their claims to the insurance company. So there is that peace of mind. You don't have to worry. But someone who doesn't have insurance, it's too late now to go and contact insurance. Because now if you go there, that I want to have my house insured, my beach insured, against these floods, of course, under fire insurance, no one will give you the risk because now it's very obvious that the risk is there. But if you had done it those days when maybe some people were talking to you, then it would be okay. You will be paid. Peace of mind. You don't have to worry. Insurances reduces the business risk or losses. This is like what I've discussed on point number 1. Then employment, definitely many of us we earn our living from insurance. So that is employment. Insurance accelerates the economic growth of the country. Yes, yeah, it does this in various ways. One, offering protection. Two, giving, revenues to the, of course, to the country through taxations, through treasury bills. So basically, it accelerates the economic growth of the country, but also that protection. Imagine if you're doing these businesses taking place in the country, they are not covered, and something comes up, they are wiped out. What will happen? Then revenue to the government, very clear. You have issues of stamp duty. We have VAT, all those revenues to the government. Then when companies make some profits, they have to pay some income tax. So, and insurance companies are now doing well, so they contribute some good revenue to the government, much as we still have some work to do. Then international trade promotion, definitely through marine, because we have this marine insurance, we are sure that our goods are protected. We also have things like reinsurance, there is exchange of some monies there. Then spread of risks, this one is also quite clear. Yes, then of course in chapter 1 we also look at penetration of general insurance in Uganda. So what is insurance penetration, and how are we doing as far as insurance penetration is concerned? So insurance penetration rate here indicates the level of development of insurance. Insurance penetration rate indicates the level of development of insurance sector in a country. What the insurance contributes, the contribution of the insurance industry to the GDP of the country. What is our contribution? We have manufacturing, we have tourism, we have banking. So where does insurance, what's the contribution of insurance? It is, and as we can see, it's measured as the ratio of premium underwritten in a particular year, the gross domestic product of a country. The premiums written within a year compared to the GDP of a country. So here, according to our study guide, which we are using at the Institute, as per year 2014, the penetration rates were at 0.85. I need to ascertain the new figures because I think we've gone slightly below even 0.85%, meaning we are doing so badly. The penetration rate of insurance industry in Uganda, if I'm not wrong, currently it must be at like 0.75. We are doing so badly, but again, this presents an opportunity. It means there is potential for you students. We are the industry is not yet exhausted like some other sectors. When you talk of, say, banking, when a new bank starting in Uganda to survive, yeah, it needs to do a lot of work. But insurance, we have potential 0.85%. Out of 10 people on the road moving, even one person is not insured. So meaning so many people out there who are not insured. So this presents opportunities for us to tap and make more money, grow the industry, and at least take the percentages, at least maybe to say 3% as we see Kenya, or 5%. So why do we have these low percentages in terms of penetration? Why is it that our insurance penetration is low? One, lack of public awareness on importance and use of insurance. why the reasons why these figures are so low. People are not aware about the importance of insurance. So this is why even IRA now says you guys must acquire COP certificate to help to be the ambassadors of the insurance industry. Go outside there and make people aware of the importance and use of insurance. I've just given an example of the floods, affecting the communities along Lake Victoria. Now, if I believe, many people were told about insurance, but you see, the policy there that works is fire insurance. So when you say fire insurance, you tell the owner of the beach or someone having a house there, and you say, please buy fire insurance for your beach. Someone will say, now, I've never heard how many houses have burned. But because they are not aware that even that under fire insurance, floods are covered under fire insurance. If they knew, they would have insured. But because they didn't know the use of that fire insurance, so they say, I don't think fire will come. And of course, even if it came, my properties are semi-detached, so if it burns one, I will have put of fire before it spreads to the next property. So this is very important. Public awareness. We need to make people aware of insurance if we need our penetration to be high. Then negative attitudes on insurance. People have that negative mentality, bad picture about insurance, that insurers are cheats, that we don't pay. Of course, those things used to happen, out of people. But it's now our duty to make sure that we tell people that now insurance is something you must do. It's now an essential good. It's now an essential good. It's an essential item. And how do we do this? We must pay claims. If we pay claims, then you pay claims. Someone now talks good about our industry, word of mouth, the gospel that insurers are good, then the other person also will insure. Then 3, low levels of education and knowledge of insurance by the general public, almost similar to number 1. People don't have knowledge about insurance. So we need to do a lot to equip people with insurance knowledge. Cultural and religious beliefs, very important. There are some cultures you cannot tell them to insure. For them, if you say insurance, let me use a good example of, say, funeral insurance. You go and talk to them about funeral insurance, they may chase you with some sticks. Say, how do you man, you want to bring bad omen to our society? How do you tell us to buy funeral insurance? You want our people to die. So these are some of the issues. The religious beliefs, we are aware, of course, some regions don't believe in insurance. We know, like now, our Muslim brothers here in Uganda don't believe in our conventional insurance. That's why for them, they have to go for Takaful or Islamic insurance. So meaning that, like in Uganda, where we don't have Takaful or Islamic insurance as yet, we are missing on their premiums, or they cannot insure. Lack of enough disposable income, definitely our biggest part of the population, the incomes are low. So when you look at the other, is it Maslow's hierarchy of need, insurance is taken as a luxury. Before someone thinks of insurance, he has to first think of, shelter, food. So insurance comes in, as a luxury. Some people say you are actualizing, in that class of actuaries, because of not enough income. Yet we need this, even because if we don't have insurance, even the small income we have may be wiped out by these catastrophes. So, but this is something that we need to explain to the masses. Then lastly, insurance industry does not receive positive publicity from the press. When we pay claims, these are not well publicized. But if one client goes to the insurance company maybe to claim for third party accident and is not paid, and he goes to the news, to the press, it will spread like what? Like fire. And everyone will be commenting. But the billions we are putting out, paying, compensating, those ones you won't see them. But something small, definitely it will get a serious backlash from the masses. So we need to change all these things if our penetration is to be high. And maybe to emphasize, for purposes of say exams, most of you students are good at cramming, which is very bad because like in this, we say reasons for low penetration in Uganda. We're explaining why insurance here is low. But in an exam, if an examiner may twist and say for countries like South Africa, where insurance penetration is so high, what are the causes of those high figures? So because for you read and what you have in your books, it's reasons for low penetration, you say that one we did not cover. Why do you do that? Because of cramming.
On, but we can't hear you. And everyone it's muted. Unmute your side. Can see you, but we are all muted. Send a message. Let's hold the message you are.
Yes, Jonan?
Yeah, we're on. Batch should be back on.
Yes. So our chapter 1 is done. As Jonan said, if you have any questions, hope you're sending them to Jonan. So we go straight to chapter 2 and we look at insurance documentation. So in chapter 2, under insurance documentation, insurance, like any other services, it's an intangible service. You cannot feel it, you can't touch. So we have to look for ways of how to tangibilize it, how to make it tangible. And the best way we can do this is to have some forms of documents. For instance, a policy document, an endorsement, a cover note, something that makes it somehow tangible. So these are some of the documents we are going to discuss, and they are very important if you, for someone who is being immense. So the first document we discuss, which is very important under insurance, is a proposal form. What is a proposal form? A proposal form is a document used to gather information on the subject matter of insurance. If you have a house that you want to be insured, how do I collect information pertaining that house? Because I need something to help me when I'm underwriting my risk. So what will I use? Will I just get a paper and write? So we must have a document which is called a proposal form, and we use this document, the proposal form, to extract underwriting information, to gather information that will guide us when we are underwriting the risk. So this form is provided directly by the insurer or the broker or agent to the client. And once this proposal has been completed by the prospective proposer, it is submitted to the insurer. So you put all the information, have it signed, then submit it to the insurer. And this is where, as we are going to see, our duty of disclosure comes in. Utmost good faith, because we believe you understand where you are risk. So when we give you the proposal form, you must tell us the truth, because this is the document we're going to base on to come up with a policy. So most cases, proposal forms are used for personal lines, personal line insurances. These small and medium-sized commercial risks, like motor insurance, fire for domestic, houses, for when we're coming up with a domestic package. These small, all risks, because for large and complex risks, like say industries, where the proposal form may not work well. So what we do there, we use some risk notes, we cut out some surveys, but for personal lines, a proposal form is
Yes, Ronnie. Ronnie. Ronnie, can you hear me? We have challenges.
Hello.
Yes, Ronnie.
Yes.
Bash is off, eh?
Bash, are you on now?
I'm back, yes.
Please.
Okay.
You have internet issues?
Yeah, the internet is somehow unstable.
You are now clear. Can we continue?
Okay. Is it on?
Yep.
Is it on? Is it on?
Yeah, I see you. I want you share the presentation.
Yes. Okay. Am I sharing the screen?
Kindly share the presentation.
Okay.
You sure?
Okay. Yeah.
Switch off, turn off your video. Just turn off your video.
I'm
Just turn off your video. You mute.
Dear members online, kindly bear with us. We have a technical issue at the presenter's side. We shall soon be back.
The presentation. Yeah. Action is timed out. You have internet.
yeah, it's on. It was full.
This presentation.
Yeah, it is very on.
Yeah, could record data.
Very. Good. You know. Sorry.
Up.
Yes, you are back now, Bashir. Mr. Simon, you are now back.
Yes. Thank you. Thank you. Sorry for that interruption, but we move on. So we were on the uses of the proposal form, which I had explained. That was on point one where I said the proposal form is used to gather information for quotation purposes. If you want to come up with a quote to determine premiums which you are going to charge a certain risk, the information collected on the proposal form will guide you on coming up with premiums, whether to put the rate high or low, depending on the information that has been provided by the proposal form. Then two, it's used to gather information for underwriting purposes. The information gathered on the proposal form will dictate whether you take on the risk or you decline it. If you go out, collect information on a certain say building, and we see that it is it's built in a flooded area, in a swamp, so we are likely to say no, we are not going to give you a what? A cover. Or if we're giving you a cover, first meet these conditions. 3, it's used as an advertising and prospecting tool. Of course, many of you know the proposal forms you use, and the way they are designed, you know, with your addresses, some of these are used as advertising tools. Lastly, it is used as a source of information during claim processing. When a loss happens and you report to the insurance company, the claims department will go back to the original information, and that is the proposal form. They compare the information now you put on the claim form with what you had indicated in the proposal form. So this is why we said when you are putting information on the proposal form, when the client is completing the proposal form, you must disclose all material facts. And he must not lie, because when losses happen, then we refer back to the proposal form. So the proposal form, in most cases, when they are designing it, it has 2 questions, because it's like a questionnaire. It's a questionnaire. It's trying to interrogate, to get some information from you. So it has 2 sections. One, the first section is of general questions, and the other section is of specific questions. The general questions here, we are looking at generic information. Things like the name of the proposer, the address of the proposer, the period of insurance. These are general questions which will appear on a proposal form for motor insurance, on a proposal form for fire, on a proposal form for marine. These will appear on each and every proposal form, generic questions. But we also have the specific questions. These are the questions which are very important. Specific, they relate to the subject matter of insurance. For instance, if you are insuring a house, one example of a specific question is the building materials used to construct that house. What are the building materials used in the construction of that? That's a specific question. The location of the building, it's a specific question. Under motor insurance, a specific question is the use. What's the use of the car? That's a specific question, because a specific question helps the underwriter in determining premiums, in accepting or rejecting the risk. If you say the use of the car is commercial and the insurance company is not taking on commercial vehicles, then definitely they will not take up the risk. So difference between generic and specific questions. For generic questions, those are normal ones: name, address, what. Specific questions, they relate to the subject matter of insurance and they guide in underwriting. So on then on the proper and declaration, our students or the agents that if you take a proposal form to the client, make sure the client signs that proposal form, because that is where the client is supposed to sign and attest. Very important, because we have a tendency, most especially agents, to fill in proposal forms for clients. That is very suicidal, because yes, you will fill it, you go take it to the insurance company for cover, but in case of a loss, the client will say me, I never filled this proposal form. All the information that is here, this is not my handwriting, this is not my signature. So you guys, I don't know what you did. So make sure that the client signs the proposal form. Even if he has no time to maybe to fill it, you can have face-to-face discussion with him, you put in information, but when it comes to signing, the client must sign, because as we saw this is where is at this point the utmost the duty of this is the second document in insurance is the proposal, sorry, is the policy document. When a proposal form is fully filled and taken to the insurer, the risk is accepted, the underwriters will come up with a policy document. This policy document, definitely, it's not a contract, but it's something evidencing that a contract exists between the insurer and the insured. It's not a contract, just have to note that, but it's something that evidences that at least there is a contract between the insurer and the insured. Why not, is it a contract? You see the policy document, it is from one side. It is, of course, from the insurer. It's the insurer that signs and the insured doesn't want sign. So it's just an evidence that it, in maybe in the case some things backfire, you can somehow refer to it, but it's not a contract. So this policy document has some sections which we briefly go through. The first, it has the heading, the preamble, the operative clause, the exclusions, conditions, policy schedule, and the signature. The first, of course, first section, which is the heading, you're looking at the, the name of the company, the address, the telephone numbers, what of the insurance company, just which are men on the top of the policy document. Then the second section is the preamble or recital clause. So this second section introduces the policy, and most important here, it spells it out that the information under the policy document has been captured from the proposal form. So it makes reference to the proposal form. So meaning that if the information provided in the proposal form is not correct, then even the policy document you are having is not the correct document. So that's why it is very important that information provided in the proposal form must be factual. So the preamble introduces and makes reference to the proposal form, and it also makes it clear that premiums have been paid or there is an agreement for premiums to be paid. Then number 3 is the operative clause. The operative clause, sometimes we call it the heart of the policy document. The heart of the policy document. This is where whatever is covered is spelled out. That this policy will make good of its obligation if this and this happens. So if that is not captured under the operative clause, then you don't have insurance. So what you've insured, if say the policy is for maybe motor insurance, the example I'd use, it will clearly state that if this and this happens, the insurer will pay you. So that's why we call it the heart of the policy, meaning that what is not covered here is not insured. So if any loss happens and the cause of loss is outside what is under the operative clause, then you don't have cover. That's why we call it the heart. The heart. So it summarizes the whole transaction. Then the other section is exclusion. The exclusions or exceptions, it is these are spelling out what is not insured. If the cause of loss is as a result of what is covered here, then will not compensate you. So when you for you students, especially underwriters, agents, if you're selling to a client and you get maybe you happen to get a quotation or a policy document, go and check on the exclusions or the exceptions. See is what you promised your client covered, or it is under exclusions. Then the other section under the policy document, the conditions. So these are conditions. We have what we call express and implied conditions. These are things that must be done for the policy to keep in force. There are things that must be done for the policy to keep in force. Things like under implied conditions, we have things like utmost good faith. You know, the principle of utmost good faith. You must keep faithful throughout. If, say, you had the house, you changed it, and maybe put a kitchen which you didn't have at the beginning of the policy, then you must disclose. Then some of the express conditions, things like cancellation of the policy. If you want to cancel the policy, you must notify the insurer. So that one, the express conditions are captured within the policy document. They are specified: cancellation, how do you handle disputes. But implied, they are not captured in the policy document, but they are implied. Utmost good faith, insurable interest. They don't need to specify them there, but you must know. Then the policy schedule, this summarizes the, it personalizes the policy to the insured. It makes a summary of whatever is captured, you know, like period of insurance, some exclusions are captured there, excesses, some conditions. So it tries to personalize the policy. The last part is the signature and attestation clause, which is signed by, this is where the authorized person within the insurance company signs the policy document to make it authentic. Then the other document and general insurance is an endorsement. It is a document which modifies the original insurance contract by enlarging or clarifying the original information contained in the contract. So if you had a policy and you want to make some changes, then the new document they give you out is called an endorsement. Say you had an insurance policy with 2 motor vehicles, now you've added on another car, they become 3. So the original contract has to be modified. So that modification, the document they give to modify the original contract is what we call the endorsement. It can either enlarge it or you reduce it. So meaning if another car is added, you enlarging. But supposing I sell a car, I had 2 cars and sell one of the cars, then I'm reducing the original cover. But what is important here that the document offered is called the endorsement. Then we have the cover note. These are temporary documents issued pending the issuance of the policy contract, which, and the cover note is valid for 30 days. Most cases valid for 30 days. So, for instance, if you imported your car from Mombasa, so that you imported your car and it has arrived to Mombasa, you want to drive it from Mombasa to Kampala, but you don't, it's not yet registered. What do? You talk to your insurer, he gives you a cover note, allow you drive your car up to Kampala. You insured for all that period till you get it registered, then you get the full policy document. So it simply states that the cover is in force. The other document is a certificate of insurance. The other document used in insurance, certificate of insurance. This is mainly issued in situations where cover is compulsory. Certificate of insurance. For instance, we have covers like third-party insurance. We have for marine, it's supposed to be insured compulsory. If workman's compensation is made compulsory, we will also see certificates issued by the insurance company to the insured. So where covers are compulsory, we expect a certificate of insurance to show that indeed you have insurance, you are covered. Then the other document we see in insurance is a credit installment plan, where premiums are not going to be paid in full under general insurance. We expect the insurer to design a credit installment plan, which will be signed by the client, by the insured, giving the time when he's going to pay the premiums. The first premium on this date, second premium after this month. So that document which is signed is called a credit installment plan. It is signed, put on your file. When the date comes, then the insurer pays you. But this is important in that because you signed, you committed yourself to pay premium after a certain period of time, then even if a loss happens, at least the insurer will work on you as you clear your premiums, because you already had a credit installment plan signed agreed on by the insurer, so you are in a way protected. But now with this cash and carry, I don't know how the insurers are dealing with this, but I believe if there is a good arrangement, especially now like with what is happening, we know the economy is not doing well worldwide, premiums may not be readily available, so a document like this one can be signed to help you have your cover keep in force. Then the other document, I think the last one is the claim form. A claim form, as we've looked at the proposal form, that was at the time of taking the policy. But now the policy is in force, a loss happens. What happens? There is a document which is called the claim form, which you have to fill and notify. After notifying the insurer that a loss has happened, then the insurer will give you a claim form which you fill and explain the circumstances surrounding the loss. How did the loss happen? What are the estimations of the loss? Does it have any third parties involved? So that is a claim form. So the document is prepared by the insurer and completed by the claimant. Note that this claim form is not an admission by the insurer to pay the claim, because not all losses will translate into payable claims. You may have a loss, you fill the claim form, but when the insurer analyzes it, you find that the cause of loss is not insured. It's not one of the insured paid, so you will not be paid. So much as you feel it, it's not an admission that you have to be paid. So some of the uses why we need to fill a claim form, we see to give us an estimation of loss, because there is where they ask you what are the estimated costs of repair. You say maybe 50 million. And again here, the claim form requires the insured or the claimant to disclose again material facts. Again, the duty of disclosure, the principle of utmost good faith comes in again. We saw it when we were filling the proposal form, but even here it comes out. You must also disclose, because some people think that if a loss has happened, they think this is now an opportunity to make money from the insurance company. You remember, you start now lying. In the proposal form, you had stated that the value of your car is 50 million. Now, in the claim form, they've asked you the value of your car, you are stating 70 million, because you think now this is the time to make money. Remember, the insurer is going to get the information in the claim form, compare it with the information on the proposal form. So if they find you lying, then you're going to be penalized. Either then if you say 70 million now, yet you had indicated 50 million, then you are uninsured, and the average clause will apply where you will end up getting less than even the 50 million. The last document is the renewal notice. We've seen that that policies under general insurance are for 12 months or less than 12 months. So when 12 months are done, we expect the policy expires. So when the policy expires, then the insurer, say within on the 10th month, when you still have the expire of the policy, the insurer is supposed to send what we call the renewal notice, notifying the insurer, notifying the insured that the policy is going to expire. And under the renewal notice, of course, you are giving the new conditions, you are coming up with the new premiums, because maybe the risk definitely must have changed. You putting in new conditions depending on how good the risk was, So all that is put in the renewal notice, which is sent to the client. It is from the insurer to the client, asking him that your policy is about to expire. Can you please give us the permission to renew it, but indicating the new premiums and the new conditions to be applied under the renewal notice. So these documents I've just discussed are the main important documents under general insurance must use: the proposal form, the policy document, the endorsement, the claim form, credit installment plan, certificate of insurance, renewal notice, and the claim form. These are the documents. You cannot avoid them, and you must understand them if you want to practice general insurance. So basically, we come to the end of our presentation, and I believe you've already sent some of your questions to Jonan. Thanks so much for paying attention. Jonan?
Thank you.
Thank you, Mr. Bashabe.
Thank you so much.
Thank you so much. Thank you so much for that presentation. A lot of the things that Mr. Bashabe has been talking about were also covered on Tuesday by Mr. Batanda. Aspects to do with, for example, principles of insurance, he did not have to dive so much into the details because these were covered on Tuesday by Mr. Batanda through fundamentals of insurance. Now, we have a couple of questions that were coming through or have been coming through our chat, the Zoom group chat. And now I would want to just simply read them out so that Mr. Bashabe can be able to give us a response. Now, like I mentioned, please give us your name. Many of you are sending, but please leave your name, know who's sending the question. Mr. Bashabe, the first question, participant is asking that please give some examples of information contained in the policy schedule. Give a little bit of details in terms of what is contained in the policy schedule, what information is contained therein. Actually, the second question, you had tried to answer it through cash and carry, but it's a very interesting one. The participant is asking if, because the documents you've been dealing with include a credit installment plan, which is signed by both the insured and the insurer. What that means is that the two have agreed that premiums will be paid in installment. Now, the question is, if a claim arises in view of cash and carry, would the insurer deny liability and hide behind cash and carry, yet there is an installment, there's a credit installment plan in place? I request you to take those questions, Mr. Bashabe, so that you can help us throw more light in those areas.
Thank you, Jonan, and thanks to the students who put forward those questions. The first one, information on the policy schedule. As I said, the policy schedule personalizes information of the client or the insured to the policy. So, and in a way, it summarizes all the information that is appearing in the policy document. So some of the information on the policy schedule, for instance, we have the policy period. This policy is running from 1st January to 31st December. That is clear. Then the other information on it is, say, excess. The excess is maybe 10%, minimum 500,000. Then you have some exclusions, very critical exclusions, where the client, most people, we don't like reading. So some information, if it's put in the policy document, some of those other pages, some client may not read them. So what we do, sometimes we bring some of those critical exclusions on the policy schedule, whereby if I get a policy, I just open and go to the policy schedule, then look at that schedule, I look at exclusions, what is excluded, so that I'm very clear that this is covered and this is not what covered. So things like policy period, excess, some exclusions, and then sometimes even what is covered, what is put in the operative clause is also summarized on the policy schedule. So the policy schedule tries to personalize the policy document and also summarize the information in the policy document. Policy period, what is covered, some of the exclusions, some of the excess clauses are all put on the policy schedule. Then number two, that's a very good question on the credit installment plan. We now have a cash and carry policy. But you see, you may be having clients whose their credit history has been very excellent. You are aware that they may not pay there and then all the premiums, but after maybe, if you agree on, say, 3 months, they will have their premiums fully paid. So when you in such instances, you sign the credit installment plan, much as there is that, cash and carry. So if a claim comes up, the fact that you sign, the insurer sign, the insured sign, if a claim comes up and the client had not fully paid all the premium, you cannot deny the liability and you hide under the cash and carry policy. No, you must, what happens, you accept the liability, then start processing. But what is very important, you immediately tell the client, as you are processing the claim, then the client should also be making good of completing the premium. Because in most cases, the systems the underwriters or claims systems will not allow to pay the claim when there is outstanding. But what is important is that you accept the liability, start working on it, things to do with, say, assessments, coming up with the quantums of what is going to be paid. As you are working on all that, then the client is also paying the outstanding premium, so that by the time the claim comes out, the outstanding premium is fully paid, but the liability will be accepted. You can't deny it. Thanks so much.
Okay. We'll go into the next set of questions.
We'll go into the next set of questions. Thank you, Simon, for responding to those two questions. Now, I have also another set of very interesting questions here. The student who did not leave their name is asking, what happens in case an exception or exclusions were not discussed with the client, but then a claim arises as a result of an excluded event? I think the worry of the participant is that the exclusions have not been discussed with the client. But again, it creates a number of scenarios, because if the policy document has been given to the client, that is also a different scenario. Or where the policy document has remained with the intermediary, as it happens at times, that's also a different scenario. But please, you help us throw some light on what happens when a claim arises out of an exclusion that was not discussed with the client. The worry is that what happens. Now, the second question, which again you will come in and help us respond to, regards a scenario created by David. And I think because normally at the college, we use the scenarios to test the understanding of students, framework. I think the students are also now coming up with very interesting scenarios. Now, David says, in case a client took on a GPA policy, okay, through a broker, the broker collects full premium and it does not pass on these premiums to the insurer. In fact, let's use the scenario of an intermediary. It can be a broker, it can be an agent who then collects full premiums from the client, but does not remit these premiums to the insurer. But then a claim arises and the insured does not make good of that claim. What is the remedy for that client? I think you take on that question, those two questions, so that then we can come with the final set of another two questions.
Thanks, Jonan. Very wonderful questions. Now, the first one, where the exception or exclusion is put under, it is the policy, and it so happens that it causes the loss, and it was not discussed with the client, what happens? You see, that's why it's very, very important. And I've seen some insurance companies fining agents who don't deliver policy documents to their clients. Now, it is expected that when the policy document is issued, there are terms and conditions that will be put there. There are exceptions or exclusions that will be put in the policy document. So that's why insurers insist that please deliver policy documents to the client. So it is the insurer is expecting that when the policy document is delivered, the client or the insured will go through and check on the exclusions or the exceptions. So once the client does not agree with a certain exclusion or exception, then he must make an alarm and say, this, if you say you guys are not going to cover this, then why am I insuring? No, I cannot take up this policy. But if we give you a policy document and you keep it, then after 6 months, a claim comes up. Then when the claim comes up, they say, the cause of loss is what it is under our exclusion, so we are not paying. You cannot say, but I did not agree to this after 6 months. So if you guys note it, I see this most especially under agents under life insurance. They must deliver policy documents to clients. If they find out that you don't deliver policy documents to clients, you can even be your contract can be terminated. So why they do that is to make sure that deliver the policy document, the client goes through it. Because if you don't deliver it and something like that happens, then the client is not at fault. But if it is delivered, we expect you to do that. So if the client cannot do that, you, the agent, remember, this is your client. You are managing that account. Try to explain. I always tell my clients, when I pick my policy documents, I look at areas, the operative clause, what is covered, and I also go to exclusions. I got, most importantly, 3 areas. On the operative clause, which is specifying what is covered, because that one spells out clearly that this is what the insured is insured against. Very clear. So if something is not there, then I ask, then 2, I go to exclusions, because what is listed under exclusions, then it means if my client gets a problem, then you will not be paid because of A, B, C, and D. So if I don't agree to them, I also first even argue with my underwriters. Then 3, I go to excess, because that's also an area of contention. You don't explain to the client that there is excess. Then when you're telling him, when a loss happens, we are going to put you back to your position. Yet in the policy, there is an excess of 20%. How do you explain it? You're paying him 100 million, this 20%, which is 20 million, 80 million. How do you explain? So those are the 3 areas which I look at. I explain to my client if I know he's likely not to read the policy document. Then number 2, on the issue you brought out of the payment, you make full premiums which go to the broker or agent, and they don't remit, then a claim, a loss happens, you forward the claim. Very interesting. On the 2 scenarios, on the agent, if indeed you gave premiums to the agent, and the agent used these premiums, and you have total proof that the agent collected these premiums, maybe he signed somewhere, there is serious proof. You remember, this agent represents the insurer. His actions tie the insurer. So if you prove that indeed premiums were given to the agent and the agent used them, the insurer must pay you, because it is his agent that used the premiums, ate the premiums. For you made good, and this agent represents the insurer. So the agent will, the insurer must pay. But for a broker, here it is quite different. You see, the broker is now your insurance advisor. Is the way the broker acts is quite different from the agent. Is your independent insurance advisor. So if you pay premiums to the through the broker, and the broker does not remit those premiums, your policy is still outstanding. If a claim is reported, the insurer will not pay you. The insurer will not pay you. It is not until the premiums are paid by the broker that the insurer will work on the claim. So you just have to finish it with your broker. That's why it is a requirement by some brokers to have covers like compulsory covers like professional indemnity. Because if this cover, if the broker now uses the premiums and you sue him, he's likely to claim from that cover of his, the professional indemnity, but the insurer doesn't want to know. Your advisor is a broker, you gave him premiums, he did not remit them, claim cannot be paid, which is different from the agent, because the agent directly represents the insurer. So when premiums are used and you have proof that premiums were paid, then your claim is paid. It's the insurer now to deal with the agent.
Okay. Ronnie, please allow me to come in. Ronnie.
Ronnie?
Okay, that's okay. I think I'm now on.
Very,
Very interesting questions from our participants. Mr. Bashaba, I think we shall go into the next set of questions, but I liked David's comment regarding the issue of exclusions and not discussing them with the client. David just made a comment and said, what intermediaries should know is that we are not postmen, that we simply deliver documents. Ideally, it's the responsibility of the intermediary to provide the information to the client and also to try and interpret. And I think you explained that quite well, Mr. Bashabe. Now, the other questions that are coming in, number one, very, very interesting around penetration. The participant is asking that you need to throw more light on low penetration of insurance in light of the low disposable income that we have as a country. So how is the low disposable income then affecting the low penetration of insurance? And I know you will touch an aspect of microinsurance and how that can then be a remedy. Now, the other question is the aspect of, again, we've had a lot of issues around cash and carry. Now, the student or the participant is saying, please throw more light on the cash and carry. Probably you need to, again, try and explain what it means. Because, you know, for some of us who were born many years ago, there used to be a supermarket called Cash and Carry Supermarket. Kindly throw more light on the aspect of cash and carry, because to a layman, the understanding of cash and carry is you have the cash, you carry away the good from the supermarket. So please throw more light on that aspect. Then the other question that has also come through regards, again, the credit installment plan. That in light of, again, and it's linked to cash and carry, does IRA support or accept the credit installment plan? For example, we are in light of cash and carry, because remember, and again, yes, the other day, Mr. Batana talked about the aspect of supervision of insurance. Because IRA will issue rules, IRA will supervise the industry by not necessarily saying that they will come in every single day and look at what you're doing. But they set parameters that you can follow. One of the parameters they have set is cash and carry. So how does then the credit installment plan come in with the aspect of cash and carry? Okay, I think you will take those questions, Mr. Bashabe, and then we will be able to proceed. Ronnie, please accept, allow Mr. Bashabe to take on the questions.
Thank you, Jonan. The first one, I think, is on the issue of disposable income. Yes? Jonan?
Yes.
Disposable income?
Yes. Low penetration?
Yes. The one who put up that question is very right. You see, I was saying, in my explanation, I said the low disposable incomes affect the penetration levels in Uganda. Now, the biggest part of our population are low income earners. So meaning that if you're a low income earner, when something to do with insurance, it doesn't apply to you, because low income earners you don't have, say, a car, you don't have, even your house, you say this one, do I need to insure it? So why do I need insurance? Not middle level income where you have a car or nice house, but here low income earners with disposable incomes. So those guys will not think of insurance. Insurance is, they see it as a luxury, for the rich people. So because of that, the levels have to keep down. They have to keep low. But now, what does IRA? What have they done to make sure they also help the low-income earners? In also, as they do that, they put the levels high. So what IRA has done is to now license microinsurance operators. Microinsurance operators, where the required capital to start a microinsurance company is not so high, so that they encourage microinsurance companies to come in, and these microinsurers, when they come in, they design products which are for low income earners. Come up with products that are tailored to the low income segment. For instance, now we have a company called Grand Microinsurance. It's one, I think it's the first microinsurance company to be registered, to be licensed in Uganda. Those guys, they have products which are cheap as maybe 1,000 per month. You buy an insurance product, say funeral insurance, for 1,000 per month, meaning in a year, you only pay 12,000. I think even they have products as low as 5,000, as long as you can have the masses. So here now, why they come up with those products, they are now trying to go to that segment, the low income earners, which don't have the disposable incomes, so that segment is also not left out. So that the segment also have some products they can buy and be insured. Why do we have high levels of insurance penetration in countries like South Africa? South Africa is one of the countries with highest penetration levels in the world, beating even the likes of those most developed countries. Why? The reason is, in South Africa, products like funeral insurance is almost a must for everyone. The products like insurance even are sold on like kiosks. On cash and carry. Now, cash and carry, the IRA came up with a new regulation that for general insurance companies, if you issue a policy, don't issue a policy before premiums are paid fully. So for an insurance policy to be issued, premiums must be paid 100%. Meaning the regulator is happening. If you between you two, but IRA doesn't want to hear that you did not pay. Meaning, you must give that arrangement a client you trust. But what insurers are doing these days, if you sign that credit installment plan, say you were supposed to pay within 3 months, and you don't pay, the 3 months pass and you don't pay, what they do, they cancel the policy because they're also trying to run away from liability. If they don't cancel the policy and the liability arises, then they are supposed to pay whether you paid premiums or not. So if you say and you don't meet your obligation, your commitment, then they cancel the policy and you are out of the system. But as per IRA, IRA doesn't want to know those things of what it is your arrangement. Yes, then I think there was a third.
Come here. Ronnie, am I on?
You are on.
Okay. Now we would want to go into the next set of questions. Like we will do only 2 because we are running out of time. And because we are running out of time, we will take 2 questions. And like I mentioned, colleagues and participants, I said, you can send your questions also to training department at iiu.ac.ug. It might not be possible for us to take all your questions and therefore respond within this session. I can see already some of our colleagues are finding it difficult to connect through. So please use our email, training department at iiu.ac.ug. If your question has not been responded to now, be sure to join us on Monday. We'll send you the link again. So Monday, we'll then be taking on more questions in the Q&A session. So Monday's session will strictly be a Q&A. So please keep the questions coming in case we've not responded to your question now, because I know you have quite a number of questions around products, general insurance products. You have a number of questions coming through around claims. There are a number of other questions that probably around areas that Mr. Bashabe has not touched on today. But we appreciate those questions and they will therefore be taken care of. So as Mr. Bashabe concludes, I would just like to just throw just 2 more questions to him, and then we can close the session. Now, I know Ronald on Tuesday took you through fundamentals of insurance and dealt with the aspect of risk-based supervision. And many of us who are participants today, a couple of us are intermediaries, specifically agents. So you would want to know how risk-based supervision now affects you as an intermediary. Because remember we said, and what I remember from Mr. Batanda was that the companies, the insurance companies now will only take on risks that ideally are covered by the corresponding capital that they have. Remember very well, under the current regulation, capitalization of insurance companies is the same across the board. But remember, the risks taken on are different, and each company underwrites a number of risks, some that are higher than the capital or higher than their capitalization. So what you would now want to know is, how does this affect the intermediary? For example, if I'm an agent and I came through with a proposal for insurance from my client, how will that be taken on in terms of risk-based supervision? Mr. Bashabe will just throw a little bit of light on that aspect. Now, there was also another question around liability. And you're saying that, of course, compensation out of a liability claim will have to undergo or go through litigation because these are legal liabilities. And the question is there an alternative? For example, can a compensation be made out of arbitration? Again, I'll also ask Mr. Bashabe to just throw a bit of light. I can see here, David, you said Metro Cash and Carry. David, obviously, I was born a little earlier than you because there was a Cash and Carry supermarket. Metro Cash and Carry came a little later. cash and carry was there earlier than Metro cash and carry. So I'll ask Mr. Bashabe to just throw in just 1 minute because we must close. We are running out of time. Mr. Bashabe, do you have a comment? I see that we are having a bit of connection issues around getting our facilitator back online. But like I mentioned, keep the questions coming in. I see there is a question on lead time in terms of if there is any regulation around the period within which claims must be settled. That question is also there. You can see it. I think our trainer is back on. So Mr. Bashabe, I will give you an opportunity to just respond in 1 minute so that then we can wrap up and close the session. The question, do you want me? Let me repeat the questions. I think the first one was around the aspect again of liability insurance. And the participant is asking that is there an alternative to litigation? Because remember, legal liability and compensation out of liability claims is as a result of a court award. So in case of arbitration, is there an option of arbitration, and would the insurer be able to settle a claim as a result of arbitration? That is the question that is coming through. Okay. The other question
that we have is the aspect of risk-based provision. I'm repeating these questions because our trainer was
off for a couple of minutes for him to just be a bit. Is the aspect of risk-based provision? The participants asked, what is the impact of risk-based provision on the intermediary, for example, an agent?
Yeah.
And the other one, is there a requirement by IRA in terms of the time within which a claim must be settled? If you can quickly answer those questions in 1 minute so that we can then close the session. Thank you.
Thank you, Jonan. The liability claims, which are mainly awarded in courts, and but is asking whether settled under arbitration. Of course, you know, in most cases under insurance, when you go to court, the courts always advise that before litigation comes in, can you first go and settle it out of court? That's why even in our policy document, it's very clear that in the case of disputes arising, we first arbitrate before we go to courts. Better if the two parties decide to settle their disputes under arbitration. So 100% the claim can be settled through. I don't want people to overcrowd courts. So if you can get an arbitrator and the two sides, someone arbitrates, you come up to an agreed amount, well and good, that's it. It is only when you fail to agree that you go to courts. Then the second question is on
time limit. Is there a specific time within which a claim must be settled as per IRA?
Yes, IRA in most cases has come up with timelines for most claims to be settled. There are timelines. They expect certain claims to bring a certain amount of money to be settled in a certain period of time. So those timelines are there, and the IRA, when they are supervising, they try to be tough on those timelines because they want to show that the industry is working, it's paying. So if they don't put timelines, someone may take a claim, say 2 weeks, set a claim of 1 million, so 1 month, and yet all the documents were provided. So those timelines are there, and IRA is very strict on them, claim timelines. Then the last one was on risk-based. How does it affect agent-based supervision is on a positive note, because you see, risk-based supervision is now making insurers to make sure that the liabilities they take on match with the capital. Anyone, you are representing companies that have the capacity now. You know, you don't need to get scared that can at any one time my company fails to pay. No, because now with risk-based supervision, the liabilities you take on must match with what you have. So you as an agent, this regulation is on a positive note. At any one time, the clients you are representing, those clients of yours you're taking, the insurance companies are protected, because now you are the companies with risk-based supervision are going to be sound. Yeah, so it doesn't have any negative effect on you, but you should be proud that it's making companies, you know, to be sound and make sure that all their abilities they are carrying are matched by the by capital.
Okay. Ronnie, allow me to come in.
Thank you so much, Simon.
Thank you so much
for a job well done.
for a job well done.
We started at
We started
10,
at 10,
and it's now 10 minutes to midday. We would want to close the session, but before I close, I would want to thank the participants. Thank you so much for taking time to be with us this morning. This has been our third webinar. We hope to hold another 2 sessions tomorrow. That is bank assurance and professional selling skills. Now, I have seen a couple of questions that are linked to sales. There's a question that came through from Hassan, and Hassan was wondering why insurance companies do not publish the success stories, especially around payment and settlement of claims. Now, these are some of the things we shall be talking about in professional selling skills tomorrow. So please join us. A couple of you are also aware that bank assurance is a new channel of distribution. They are now intermediaries in the sale of insurance. And for some of us who are intermediaries, these are now our competitors. It is very important to know a thing or two about your competitor. Please join us tomorrow so that then we get to learn how the banks are doing it and how we can equip ourselves to even beat them at this game. Please join us for bank assurance tomorrow and professional selling skills. Very, very important webinars and training sessions that we shall have tomorrow. Thank you so much for the questions. Like I mentioned, continue sending the questions through trainingdepartment@iiu.sc.ug. Monday's session, Monday 4th of May, the session will strictly be a Q&A session. I know Simon has not gone into the products. Send the questions around products, and our trainers will be at hand to respond to those questions. I love the scenarios. If you can come up with as many scenarios as possible, please send them through, such that when we dive into the session on Monday, it's a bit orderly and we'll have received the questions well ahead of time, but we do not then waste time on Monday. So thank you so much to the team from ITC that has been behind these webinars. Thank you so much, our technical department. Thank you, my colleagues from the training department and exams department. They have been online. And thank you for our other standby facilitators that have also been online and also been listening in and picking out some of the most important components that the participants have been interested in. So we thank you for taking off time this morning. And I would want to sign off from Wakiso here. Please, again, my name has been Jonan Chisache, your host for these webinars. Join us tomorrow, same time, starting at 10 for the next webinar, but please keep the questions coming. I would want to wish you a wonderful rest of the day. The sun is coming out here in Wakiso. I hope the same is happening on your side. It was a bit of a chilly, cold, windy morning, but the sun has now started coming out, typical of the Ugandan climate. Please take time to enjoy as you step out of the sun. Thank you so much, and I wish you a wonderful time. Bye for now.